Okay, monitoring, measuring, identifying, assessing, measure. First of all, you have to identify the risk. You have to assess. So the process of assessing means that you have to check what are the pros and cons. What are the things I am exposed to? If this thing happens, what is the impact? Then you measure. Measurements. I don't know if you can remember risk metrics. You measure by saying, okay, what is the probability of happening? One, what is the impact if it happens? So that you'll be able to know the ones to prioritize, the ones to pay more attention to. It's just like in banking. You pay more attention to credit risk, which is, you know what it is. The probability of happening is high. The impact is also high. So you prioritize. The same thing with fraud. Probability is more than 20%. The impact is also very low. It can destroy the organization. So you prioritize. So you channel energy resources towards managing those ones that have greater probability and yes, severe impact. That is where you mention. Then that is assessing the capability. Then you now look at the mitigants, the controls. Then you also monitor and report. So that is what risk management is all about. You know, we stopped at I think it was 2020. Yeah, we stopped at 2020. And okay, can we also, what is the difference between credit risk management and portfolio management? What's the difference? Let's just refresh our memory. The difference between product management and credit risk management. I know we answered that question by ourselves, so we should remember. Product risk management and credit risk management. You know, product risk management is an aspect of risk management. Credit risk management is under credit risk management. But I want you to tell me the difference. How do we implement it? You can't remember. Can you remember? Credit risk management. Let's try.
And if not, because we will not sell.
Can you try?
Looking at the product risk is the part of then we look at the product that is delivery and issue. Both for our product that we are having, micro delivery, we are having everyone that are product just is handed and after why portfolio is just a general
okay, let me help. Okay. Which one are you talking about? Okay, credit.
When the customer does not meet up while the other hand, the product, the bank have to be careful with that of product they advertise. What are they saying?
Okay, you know, we said credit risk is all the activities, processes, procedures that we employ towards making sure that the money we give out comes back. I don't know if you remember credit appraisal. How you give, either you decide to give either individual or group. You talk about credit appraisal, all the things you're supposed to do during the process of the things that you're supposed to check. Remember, we mentioned 5 C's of lending and the rest of it. So all the activities, procedures, processes you put in place to make sure you recover your money at the end of the day. While product is managing your credit portfolio, as in your loan portfolio, along sector, region, maybe how you want to, what do you want to, what portion of your loan, or what, how do I say it now, quantity, yes, maybe volume of your loan do you want to lend to agri sector, trade, health, insurance and others. What is the proportion? Okay, in Calabar, how much do you want to disburse within Calabar? How much do you want to disburse to civil servants? And how much of your loan do you want to distribute to SME or trade? So you manage your portfolio alongside sector, region, type, maybe either micro loan, or are you doing more of micro loan, or are you doing more of SME? You understand? So these are the basic difference. Like I said, the product management is part of, because in trying to manage the portion of your loan that you distribute to a particular sector, you're also making sure that, okay, let me do diversify my risk by not concentrating maybe all my portfolio in a particular sector. Assuming you want to focus on civil servant, for example, or that civil service loan or civil servant loan constitute maybe 80% of your portfolio. You know that when salary is not paid, or maybe when they go on strike, or when government refuses to pay, you know what it means now. That means they cannot pay. So you know that you are exposed to risk. But when you balance it, maybe you give 50% or 40% to civil servants, and you give, let me say, 50 or 60% to the trade. That means if these people didn't pay, these people can still pay. So you're also trying to manage your risk. So they are just so let's go to the business of the day. It's not less like operational risk. It's not here now. Continue. Back here. So operational risk. Let us start from there. I didn't want to rush it because, of course, we have there are so many risks. We have different types of risks. There are so many risks that fall under operational risk. So operational risk is defined as direct or indirect losses resulting from inadequate or failed internal processes, people, system, external events, or unforeseen circumstances, or unforeseen catastrophes. It includes exposure to losses resulting from a failed manual or automated system to process, produce, or analyze transactions in an accurate, timely, and secure manner. Like I said, there are so many risks that fall under operational risk. We have people risk, we have processing risk, we have system risk, we have external events, we have legal, and we have reputational risk. So all these risks fall under operational risk. But let's get to the next step. So these are the examples of this risk. You can see process risk. What do we call process risk? These are the dangers that we were exposed to in the process of, so many things we do in the bank follows through. There's a process flow of whatever we do. Assuming you want to take loan, for example, there are processes. The customer applies, you do the documentation. After the documentation, it goes for approval. So that is the process flow. If somebody wants to withdraw money, you come into the bank, you write your withdrawal, you hand over to the cashier checks the signature, check check if the picture as the account mandate, the picture of the customer, check if the date is correct, the amount in figure tallies with the amount you work, the name you wrote as in the name of the account also tallies with what they have, the information they have. These are the process flows. So there are risks that are associated with these processes. But you can see inadequate, incomplete documentation, of course. If you don't have, if you have incomplete documentation, assuming you gave a customer loan, you didn't capture the person's address. Of course, when the person defaults, where do you go? How do you locate the customer? How do you visit the customer? How do you contact the customer? Assuming you get a wrong phone number, assuming you didn't even get the phone number at all, what information are you going to work with? You can see inadequate record keeping. If the records you are keeping are not complete, untimely transactions capture, unapproved transactions, lack of clear reporting lines or segregation of incorrect, these are breach of regulation, money laundering, these are all process risks. You can see the example. Then people's risk, it has to do with human beings. They start inadequate staffing, overreliance of few staff, failure in retaining employees, hiring on skilled staff, all these things are risk, and they fall under operational risk. This one is system, of course, system risk, IT related, program errors, incompatibility with application, technology interference, failure in hardware, unauthorized access to system information. These are the system risks as the IT related risks. Then you have the external factors, external events like natural disasters, fire, war, terrorism, crime, robbery. These are external factors or external risks that the organization faces in the course of their business. Then you have the legal risk. The legal risk includes the breach of regulatory requirements. If the government says it is pay tax or they specify the percentage of tax that they're supposed to pay, you don't comply. If you don't comply, of course, there are consequences. You can see when they put up all these their sanitation fees, whatever. If anyone is giving to, they can sue. So there are implications. If you don't comply to the to laws governing your environment, you understand? You are also so they are all examples of the operational risk. Then why is operational risk important? Apart from what is written there, why do you think it's important? Why is it an important subject? Why are we even talking about it in the first place? Why is it necessary that we know so that we know how to manage them? Why do you think? You can see I've shown you the types of operational risk. You can see it forms part of most of the things. Aside, even credit risk is also part of what it just said now. Like incomplete documentation, it's still a process risk. So why is it important? Why do you think it's important?
Because it flows back for us. In the case of documentation, the person is working to the environment to access the facilities. The first person make the loan officer does not do the need report to the inspector. They do like the parents.
Okay, of course. What you are trying to do is to save the organization so that they don't lose the money that's as in the shareholders' funds or the capital. The complexity, as in the technology has really, yes, it's easy on the face of it, convenient, conducive, whatever you want to call it. It is better You stay in the comfort of your home, you make transfers. But there are risks that are also associated with that because using technology also comes with a whole lot of risk. You can see increase operational losses in banking businesses. Rapid steps have been taken in innovations, of course, automated systems like the app and maybe internet banking and the rest of it. These things, as you advance, as you innovate, definitely it comes with a whole lot of things. Because any business you want to do, or anything you want to do to aid your business somehow, or to aid your process somehow, there are risks that are associated with whatever, even product development. When you are developing a product, there are risks that are associated with that. Like the agri loan that we just the three agri products that we just launched. There are risks now. By the time the bank sells that product for like 3 months, or let me say 6 months, you begin to get feedbacks that this particular thing you put in place is either adequate or not adequate. This mitigant that we put in place to manage this is either it's weak, needs reinforcement, or needs to be changed entirely. That is why we say risk management is a continuous process. By the time you take it, okay, this is where what you are supposed to do. We didn't do it, so okay, let us go back to the grind. How do we, tighten those loose ends? How do we bridge those gaps that are already there that we have noticed in the course of, setting that product? Then we have required focus, of course, corporate governance. We talked about corporate governance last week. This corporate governance that we are talking about, if you don't have a good corporate governance in place in any organization, that's a problem of this sector. It can even destroy the strongest institution. If things are not done the way they are done, if you don't apply professionalism, ethics, the tendency is that the business will definitely suffer because people don't do things the way they're supposed to. People don't obey rules. People don't do things based on the policies. There is no guide. You can just wake up and take decisions. But when there are policies, controls in place, you'll be able to act according to those rules and regulations. So can we move forward? Then we have this operational risk management tools. These are tools that you use to manage operational risk. Number one is that we have a key risk indicator. This is measuring the likelihood that the combined probability of an event and its impact will exceed this institution risk appetite. I don't need to remember risk appetite. We talked about risk appetite last time. Can we remember what risk appetite is? Risk appetite. You said so much about it.
It's how much risk of that.
Eh?
Yeah, much risk.
How much of it that you are willing to accept based on your capacity, how much you have, and the rest of it, the resources you have. Then you have the loss events database. The tool captures and accumulates individual loss events across business units and risk types. It measures, quantifies, provides financial operation risk data. We also mentioned the risk register, if you remember. Then we have this the risk and control self-assessment tool. This identify, assess, control, and mitigate operational risk for effective reporting and monitoring of current and emerging risk issues in the institution. Then we also have scenario analysis. I know I talked about this scenario analysis. That scenario analysis has to do with, because of the variations in either the market risk, in either interest rates or market rates. Maybe the interest rate when it's high, you now imagine that okay, this is assuming you have treasury bill and bulk of your investment is in treasury. Maybe you have up to 60 or 70% of your investment in treasury. Of course, you'll be interested because it means that your investment, the income that comes from treasury will constitute also maybe 80 to 90 or 70 to 80% of your income. So you should be interested in what happens when the rates fluctuates. If it is high, what happens? If it is low, what happens? You'll be able to know your position so that I'm prepared for it. When the rates are high, this is our position. When it falls below certain, you just use those different scenarios to capture your position or where you will be if such happens. So that is when we talk about scenario analysis. Let's move on, please. Some of these things you can read them in details. Of course, this is the relationship. You say that internal and external loss data. These are past risk exposures, as in the ones that have happened. Then the key risk indicators is talking about the current risk. While this one is talking about, you use it to measure future exposures. You use this to measure past risk exposure because when you check your past risk exposures, you'll be able to know the risk that your organizations are. And that wouldn't be need for, because of course we share the slide like this. You understand? So this one, you use it to measure future. Like I said, you can see that I talked about scenario analysis. You are looking at, you have not, that risk has not come, but if you are looking at the future, what if something like this happens? You are looking at the future. This is where, and when you do that, okay, what are the actions we are going to take now? You understand, to mitigate against those risks that may occur in the future. So you may be, it's okay. If maybe based on what has happened, maybe in the last 6 months or 1 year, you'll be able to say, okay, within 3 months or 4 months, the interest rate has changed. That means the likelihood that it will also behave the same way is there. So what do? Do we diversify? Do we push this our treasury bill, the money that we have invested, do we push it to other types of investment? Maybe let us give more of loans instead of putting all our money in treasury bill. Let's focus on loans so that if anything happens, we also know that we have interest in people that pay, and that is money. So we are talking about the future occurrences that have not happened already. Can we move forward? Just move to the next. I'll just give an explanation. Okay. We talked about key risk indicator. These things that are here, they are not in your manual. I just brought them in so that you'll be able to understand how these things work. The KPIs, they are range of operational efficiency to which risk class can be triggered if indicators move outside that range. And remember that this range we are talking about our risk capital. Are you getting it? If you have, this is our risk appetite. We won't take far above 5%. That's your risk appetite. If you remember, I showed you a table where we said this is the within our risk. This is a trigger. So that trigger is a red flag. Are you getting it? It's a red flag. That's okay. Assuming you say your risk appetite on loan is 5%, for example, or you decide to do it below, you must not use that regulatory threshold to do your benchmark. If you do it, that means the tendency that you will shoot above that is there. You can decide to say, okay, our risk appetite for PAR is 3%. So when is exceeding 3.2, that's a red flag. Are you getting it? It is calling your attention to monitoring your loans. Who and who are not paying? It is increasing because if you don't take measures to bring it back to your target, what it means is that by the time it gets to 3.2, 3.5, then it is going to your maybe that risk, that's a worst scenario or that worst case scenario that you are looking at. Maybe you place it at 4. So when it is above that accepted risk level tolerance, it is a red flag. So you use it to indicate when there are red flags. When they move aside the way, the key performance indicators, example, I just gave the example. Staff turnover rate. Like I said, you have to, first of all, is that you put that appetite, the risk appetite. You can say, okay, our staff turnover is, let me say 1%. Remember that I said all these things are influenced by your level of your exposure and the risk culture of that organization. Do you want to lose your staff? If the answer is yes, you can say you have 0 tolerance to staff turnover, which in practical this thing is not possible. People move. You can't deny them that this thing. But at what point do you start taking action or noticing that people are leaving you? If you have 200 staff as at this month, next month it has reduced to 118. What is the percentage? You can express it in percentage. You can say 118 over 200 times 100. It will give you the percentage. You can say, okay, my staff turnover rate is 2. That's the acceptable tolerance level, 2%. So when it's going above 2%, it is ringing a bell. So what are you going to do? What is the reason behind people leaving the bank? What are the things that we're supposed to do to keep them, to retain them? Because human resource management or process of recruitment does not end in bringing in the person. It ends with retaining the person. If you employ somebody that you cannot retain, you have not successfully done your job. Then you also look at system downtime. How often do we have system downtime? Maybe in the whole day you not post because you have a glitch, or maybe the rain that falls today, maybe it has disrupted your system. How often? What's the maximum you can take? So these are the key. The KPI, the key performance indicators. These are the things that you are looking at. I showed you that table. These are the things you are looking at. That is what you are using to measure or to assess your risk management skill. Even the mitigants that you put in place, you test if they are working or not. Because if the controls or the mitigants that you have put in place to manage any of this, if they are working effectively, it is from these things that you know that they are working. The mitigants or the controls that you put in place, it should affect on these things. You say you don't want part to rise above 3%, for example. What are the things you do? Okay, you said, okay, we make sure that we appraise well, we make sure we dispose to the right people that have the capacity, the character to pay this. We are going to monitor as soon as we monitor, as soon as we discuss, we are going to monitor, maybe go back and make sure that the money that we gave the customer was invested in the business. These are the processes. What are you doing? All these things you are doing, you want to make sure that you're back. So if all these processes or these mitigants that you have put in place cannot control this, it means that those controls or the mitigants are weak. So it calls for action. You have to look at it. Either the right people are not implementing they don't have the skill to implement the mitigants, or the mitigants itself are weak, not strong enough to manage that risk. So these are then you have the KCI. These are the key control indicators. Successful test of system inclusion, number of branches without a manager. The control indicators. Then the key risk indicators is the selection of KPI and KCI from a pool of business data indicator for the purpose of risk tracking. I don't know how to explain this now, how to track those things. Like I said, you look at it month by month. You assess them month by month to see if they are in line at every point in time. Does it stay within that risk appetite, or is it going outside that? So you can see when it is normal, we call it business as usual. It's okay. When it triggers, of course, providing allowed to take remedial action before losses, it is sending a signal. Then the limit is the maximum level that you want to do. At this point, what else do you do? The mitigants or the control that we put in place needs to be either it needs to be reviewed, or we talk about, okay, can we train our loan officers? It is either they are not appraising their customers well, or what do we do next? Since everything that we have done are not working according to, are not giving us the result that is supposed to give us. So there is need for review of the entire process, either the mitigant itself or the people or the resources that you have channeled into it. So you look at the two and see the ones you can. Move forward, please. So these are the examples of things. You can read this up so that you get to internal control. Please move forward. When you have the slide, you can read this one, so you see the same thing. So continue. Then operational, when we talked about credit risk, of course, we also talked about credit risk management. This one is operational risk management. It's defined as the cyclic process, which includes, of course, assessment, decision-making, implementation of risk control, which results in acceptance, mitigation, or avoidance of risk. The goal is to protect value, ensure business continuity, and maintain shareholder or stakeholder confidence by preventing or minimizing loss from operational failures, of course. That cannot be overemphasized. That is need. Like I said, any risk management process is always identify, assess, put control, and also, report whatever risk that you have, all the things put in place. Can we move forward? Then this one is business continuity management. Have you heard about business continuity management? Have you heard about business continuity plan or disaster IT people now? Disaster recovery. You know that one. Yes. So, we are talking about operational risk. So this business continuity management is a process that helps organizations ensure that their critical business functions will continue to operate in the event of an unexpected disruption. It is about identifying potential threats early and planning for how business operation could be impacted. Assuming you are, maybe, this is, what's the name of this branch now? Charlie. This is Charlie. And you wake up one morning, you came to work, and you don't have access to enter the bank. Maybe because of the riot, protest or something. They now blocked this whole place that you can't have access to come into this place and it's open for portals. Do you have measures that you have put in place for customers to continue to, so that it won't be as if that because we didn't open today, our customers have not been served, or that we cannot give that service to our customers? So it is a deliberate action, the things that you have put in place to make sure that all those unforeseen circumstances, if they happen, even if it is fire, that you continue to operate. I don't know if you visit all these, maybe, of course, banks, they are in banks. You will see exits. You will see alarm or something. Then you will see muster points. And so when something happens, that building is on fire. That thing is showing you, it's giving you a signal that you can exit through this place. And if that thing happens, after that incident was happened, at the end of the day, people come to that muster point. So anybody that you didn't see there, it means that you can start asking questions. What happened? What happened? What happened? You understand? You are trying to control. And in that process, what happens? Who does what? Assuming there's fire now, who is supposed to give the alert? When that alert is given, what next? Who is supposed to escalate? What are the staff supposed to do? Who is giving signal to the staff? Where are you going to? How do you get out of the building? You understand? It has to state what happens at the end, but who does what? Who is supposed to? And after that, who reports? These are the things that you have to make sure that if you have that system downtime, or maybe the one that I know we've been talking about, what is it called? Backup. If you don't have backup and there's a breakdown, though this day, data and the cloud, you can't do them completely. So if you can't do them completely, maybe somehow you are safe. But if it is all those times that we used to have a server, you may wake up this one morning and you can't have access to it again. If you have backup, at least with that backup, you'll be able to pull your back and continue with it. So in that process, whatever is it that is the disruption has not succeeded in making your business, you still have that opportunity to continue on despite the disaster or despite what happened. While the business continuity plan ensures a business can continue operating during crisis, that is the goal of it. You know, it is two. One is business continuity plan. One is disaster recovery. Disaster recovery has to do with IT. Assuming there is a very serious attack on the IT system, how do you cover data and also continue your operation? So this thing is in the manual. That's why we brought it in case you are asked. You know, it is a multiple service OBJB. So they can put in what is this, or they can see which of these options best describes this people. You'll be able to answer. So that's why we are bringing all these things there. All these things. Can we move on? Then, of course, the benefits. It frees up capital, of course. What it means, freeing up capital means that you will spend the money that the owners invested in business to do provisions. When somebody commits fraud, assuming you didn't succeed in recovering the money, you make provisions. And you are making provisions from, if your profit can no longer carry it, it's going to attack your capital. Because your capital, if you can't provide from the profit, then you can provide from the capital. And by doing so, it is depleting your capital. So if you manage your operational risk very well, avoid fraud to the barest minimum, manage your credit risk to the barest minimum, do everything that you can. You don't pay so much as a result of sanction. You didn't comply with the regulatory guideline, and CBN fines you, you pay fine. It's an expense, and all those things impact on the capital. So if you effectively manage your risk, it will free up capital. Then we have better decision making, of course. With a good risk assessment and analysis, you make good decisions where you must have identified, assess, and do proper mitigation. Of course, you will be able to take better decisions. Low cost of funds, you'll be able to mobilize funds at a low cost. Can somebody give me a scenario of this now? How can good credit risk or whatever, operation credit, how can it lower cost of funds? Can you relate it to a real life situation? How a good risk management process or measure, whatever, can lower your cost of funds? Just think about it.
It is high. If that- how we call it. It is- that is what the numbers are.
Let me explain. You know, they say the business of banking is based on trust. They trusted you. That's why they're giving you your money. That you open the account in Zenith Bank means that you trust that your money is safe in Zenith Bank. So if that is the case, if you have a negative perception of Zenith Bank, will you go there? You won't go there. So when you have that trust, as a result of positive image you think they have, you are going without anybody forcing you to go and drop your money there. Whatever rate they are giving you, you are taking it. So if you have been able to successfully gain public trust and confidence, you mobilize lower costs now, because you don't need to do too much to get people to come and bank with you, to get people to come and put money in your bank. You don't need to do too much. Even the fixed deposit that we are selling is expensive. But if you are able to mobilize more of normal savings accounts, current account deposits, you won't spend so much, because you're not putting so much in it. You're not, trying to increase your costs in order to mobilize deposits. So if people have a positive perception of your bank, you have the good, the public perception about your bank is positive, they will come and give you money. So the money that you use to trade with, you mobilize it at a very low cost. You don't need to, put interest so high for you to mobilize this, and you can successfully achieve that when you must have managed all your risk, including reputational risk. Then we have, of course, less profit and loss volatility. Of course, your profit and loss will not be this month. You have made profit. The next month you have made loss because a customer refused to pay. A customer that you gave 50 million naira refused to pay. Your profit will be like this. Next month the customer pays, it will be like this. The other month, the other one refused to pay. So there should be stable growth, even if there is no growth. It should be stable. Then, of course, increase customer and staff satisfaction. Then, better regulatory compliance. Then, this is institutional risk. Okay. What are the Okay, can you mention just one thing that will happen that will make the bank to have a negative public perception about them? Just one thing. One thing that you know that is capable, that if it goes out, that is, if public or people are aware of that particular thing, it will give them a negative perception about your bank. Just mention one thing. Inability to reach your maturing withdrawal. Yes, they come to withdraw money and they don't. Yes, that one is a major one. I don't think there's any bank that's right.
Like more than that, I believe they might get like 10 to
Okay, of course. Fraud. If it goes outside. That is why some of these commercial banks, if you see the amount of fraud that happens there, do they talk about it? They don't talk about it. You won't hear it. Even when it happens, you will not even, nobody will talk about it. It is not in the news. Because immediately it happens, it is sending signal. The signal is sending that, one, you have a weak internal control system. So people can easily break into your system or your control mechanism and break it easily. So even when it happens, you don't hear it in the news. because they are trying to avoid or manage their reputational risk. Because reputation has to do with how public, how customers, their perception about you, how they see you. Because no bank should joke with this, because like I said, business of banking is based on trust. Anything, if they don't trust you, they don't do. Unless of course you know, they know that nothing is at stake. But if it is for your deposit customer, or even other stakeholders, the other stakeholders includes your shareholders, the government, anybody that has interest, even the staff, you are a stakeholder. So the risk is talking about a negative, this is the potential for negative public perception, threat or danger to the good name or standing of a business entity. People occur directly as a result of actions of the company or indirectly due to the actions of an employer or employee. So we have the sources of reputational risk, we have internal sources. The internal sources are employee conduct, number one. Somebody mentioned fraud now. Who do fraud? Employee. That is bad employee conduct. Action by employees such as harassment, discrimination, or other misconduct can lead to negative publicity, of course. You know, that's, I heard that sometimes, you know, maybe staff or some staff defrauded customers, the people that give them deposit and they give them cash, something like that. And of course, the impact of that, you know, act was so much on the bank that, you know, something that made the bank to even say, we are not going to do this again. Very savings. But does it mean that they don't collect money from the customers again? And daily service was not, it's not compulsory that you must give them cash. It's not, is it compulsory? Okay, you mark it, yes, and they will confirm that you have marked. No. Yes, the confidence is a little bit. At least when they are seeing it, at least I've contributed 30,000. That's what I'm saying now. It is as a result of this employee conduct now that we are talking about reputational risk. It is because some people took advantage of that, collected money from customers, marked their cards, and the customer believes that my money is in the bank, and I'm looking at my money, I've contributed 50,000. They have that confidence, and they are hoping to use the money to do something, only to get to the bank, and we are telling them that all those monies are not there. What do you think happens? When such news gets into the market, do you know what will happen? All the money that I contributed, they is not there. You want to collect your money. I don't think that any bank, no matter how strong you are, I don't think that any bank will survive wrong. So the conduct of employees can do that. Of course, discrimination, harassment, anything. You know, they say bad news goes far. The good ones, no, they struggle to sell. But that bad one, it sells far. You see, they say this is what they do in their account. You tell Mr. A, you tell Mr. B, you tell Mr. C, you tell Mr. C, and it's great. Then we have ethical violation. Of course, business practices including fraud, bribery, environmental negligence can significantly damage companies' image and public trust. Then poor product or service quality, the one you talked about. If you request for transfer, you will not get that transfer till tomorrow. If the customer remembers to put you somehow, getting this money now be a problem. It's better. I don't want stress. Why do you think OPay and money points are selling? Because of the quality of the service. You do transfer, the person gets alert immediately, instantly. The person transfer to you, you get alert immediately. In fact, average of, unless the ones that are, you know, financially excluded, maybe as a result of the locations, maybe they're in the village. I don't think there's any average. You will meet 3 people, one of them don't have either market point or account. In a circle of 3 people, one must have either owned or money points. I don't want to talk about that. Will do that next week. So they are there because of that quality of service that their systems renders. And you know, for you to live, how do I put it now? For you to leave a mark in customers' brain or mindset is their experience with you. Customer experience. It can be negative, it can be positive. So when they have, by their first interaction with you, if the experience is good, you see them changing their mind may not be that easy, but if it is bad, of course, changing their mind to also come back will not be there. Then leadership and executive is front of course. If it is bad and before. Or assuming maybe let me just that's why all these politicians, even when they have investment, assuming they have bank, you will not even know that they are the owner of the bank because people see them as they are corrupt. If I put my money here, it is not going to be safe. Therefore, I'm not going to put money. So if there's bad leadership, people perceive them to be bad, of course, it's true. Workplace condition, unsafe or exploitative working conditions can damage an employer's reputation and attract negative public reputation. Of course, people talk too much. The way you treat your staff also goes out. So it can also affect. Then the external sources, cyber security breaches. If you are in the habit of collecting data for customers, you go and do another thing, like some banks do. Somebody will say, what they do now is to go and open account for you that you didn't request for. Some of these marketers, in a bid to meet their target, they do that because your information is maybe you have submitted it somewhere. Then somebody is using it too. Somebody can even print your NIN and say that you guarantee him for a loan. After all, how do you verify customer signature, guarantor signature? Assuming you didn't put measures in place to have a one-on-one discussion, visit the guarantor and make sure that, madam, you are the one signing this loan. Sign in my presence. Let me see. Are you getting it? But if it's, oh, yeah, go and fill form and come back. You know so many things. Then social media or PR crisis. All these pictures that they say, hey, this dog has killed 10 people. Do you know? Because that people know that impression, all those things are fake news. You see one biscuit, they say, hi, this biscuit had killed. Hi, don't give your children this biscuit. Though. That is bad. And you know, you are seeing what happened to them. If not that all those ones are already, people can say, hi, is this how they harass their customers? I'm not going to. Of course, regulatory and compliance. Okay. The PR, you know what PR is? Public relations. Your relationship with the public. If it is in crisis, how would you? It is still a public image. Then regulatory and compliance failures. We have external crisis, of course, natural disasters, pandemic, cyber attacks, and other things. Then we have third-party failures. What do we mean by third-party failures? At least I know we have third-party services. What do you understand by that? Third-party failures. If there are, you are not the one. You are not the. Maybe you are rendering services to a third party. Not by one. It's just like this transfer you talk about. For example, the app. You know when you transfer money, it hits somewhere before it gets there. So if there is failure in the third party, as in, let me say the bank, that it goes there before it leaves and it hits a particular thing. It is on you now. Your customer is not seeing the other party. The customer is seeing you. It is your system failure. They are not interested. So like what you said now, sometimes it is not always from you But the customers are not seeing this. They are seeing you. They don't understand these processes. Even in commercial banks, it happens. But that of commercial bank, they will tell you that they have system failures and they cannot, you will see that from 6 o'clock a.m. to 6 o'clock p.m. You can't even do anything. You can't transfer money. If somebody transfers, you can't get the money. For a whole day, customers will, it's okay. But when it comes to microfinance, it is a problem. So if there are always failures in your maybe third-party systems or your third-party arrangements or relationship, it also affects you because the customer is not seeing the third-party. Customer is seeing you. Then the market and stakeholder opinion. Like I said, stakeholder opinion. Everybody is a stakeholder. The government is a stakeholder. The employee is a stakeholder. The shareholders, they are the stakeholder. The regulators are the stakeholders. So when they have, if they have a negative opinion about it, even the market, we're in a particular market, we're in a particular environment, how do they see? So these are external. You have those ones you don't have control over them. So this one have control to manage them. So let's move forward. Then this one is, you can see we got these ones, Basel Accord, that is Basel 1, 2, 3. This refers to a set of banking supervision regulations set by Basel Committee on bank supervision, which was formed to enhance financial stability by improving quality of bank condition. It was revision, these are history. When you the manual, it is there. But the key thing that, and it is not a local, how do I say, it is not a Nigerian thing, it is not a local, how do I put it now? Banking regulation. It is international standard. So whatever happens, whatever decisions that are taken there, the member countries now. So in your manual, it talks about the history, the different Basels. It has Basel 1, Basel 2, Basel 3. You know how you have policies. When you notice a gap or so much inconsistencies in your policies, you try to also review and come up with another decision. So that what happened. And we have Basel 1, we have Basel 2. So if you see your manual, you'll be able to read up everything, the years and different policies that are under each of them. So let us not waste so much time. Let's keep on. Then this one is the different accords and their focus. You can see Basel 1, 1988. The focus introduced the concept of capital adequacy for banks by focusing on credit and market risk. This measurement is that it categorizes assets into broad risk. That is the example. Like you see, last week, they taught you about capital adequacy. Capital adequacy ratio, that it is 10%. These are the things that, like I said, when they take decisions, the member countries, then this is because the goal is to ensure international banks held a minimum amount of capital to meet their obligations. Then, Basel 2, 2004, focus to make capital requirements more risk sensitive and comprehensive by incorporating operational risk. You know, this one is market risk. This one has incorporated operational risk in addition to credit and market risk. So that means this one, they now focus more on risk management than capital. Then the three pillars, of course, minimum capital requirements, supervisory review process, and then market discipline. This is for Basel 2. Then you have the Basel 2010, the focus, a direct response to 2008 financial crisis. So when they must have put this in place, did this solve the problem? No. So they have to, after the crisis, they have to come back again. And I don't think they have yet another Basel 6 that means it is working. So if I read them all, but this particular one is not in the manual, but this is just a summary of their major focus, differences, and the things they talked about. So can we move forward? Then, capital adequacy, like I said. Why I'm bringing some of these things is because they are in the manual. Since they are in the manual, you should know. When you see them in your questions, you'll be able to answer. Of course, banking refers to the stock of financial assets which is capable of generating income. So this is a professional definition. In a layman's capital, in a layman's language, what is capital? Language, yes. It's not the one that you start up, of course. You can also you can invest and reinvest. Maybe when you get your profit, you plow back into the business. Then we have this capital adequacy ratio. It's the thermometer of bank's health because it is the ratio of its capital to its risk. Capital adequacy can indicate the capacity of the bank's ability to absorb the possible losses. That is why you see from time to time the capital is reviewed. The more you trade, the more risk you are exposed to, the more funds you need to, withstand the. Because the more you're trading, at a point you decide that you are going to give one customer. That is why you see this. What is it called again? Single or giving. Why did they place single or giving? You give according to your capital. That is why it is tied there. Loan is a risk. It's a risk asset. So for you to take on risk for an individual or a corporate body, this is the percentage. Don't give above. If you feel you have what it takes to then inject more capital, also increase your single or giving. So a bank that has 1 billion as a shareholders fund, the amount you give to an individual is different from a bank that is trading to 100 million. They are not the same thing. So it means that the capital is tied to the volume of your risk. And the formula is capital 1 plus 2. Of course, they give you the formula is risk-weighted assets. Of course, we know assets. But when they say an asset is risk-weighted, it means that you assign a percentage of risk to the asset based on the exposure or based on the type of capital that it is. Like for cash, by CIBN standards, for cash, there's no cash, there is 0%. It is not risk-weighted because at every point in time, the value of 10 naira, as far as you are holding it in your hand, the value is the same. But when you invest in the bank as a placement, it's a risk because it's no longer in your hand. The probability of coming back 100% is no longer there. So you assign a particular percentage of risk and say, so I invested 100 million in placement. The probability that I may get it or may not get it is there. Therefore, I want to assign the percentage of risk. Okay, out of 100 million, okay, 20% risk. Okay, let me take out some portion and look at my real asset as 80 million. So when you are doing that, you are risk-weighting your asset. So there's a formula. When you get the total, capital 1 and capital 2, of course, it was the same. Capital 1 is just the pure capital that is invested, including your gas and other things. While 2 includes the preference shares and other things. So let's move forward. Is it the last slide? Okay. Go back. What's your question? Yes. That is not all the organizations that have capital. It's not all the organizations that have. Like Microfinance, they don't have potential. They don't have all those. The one they have is what one. That one includes the paid up capital, the reserves, maybe share premium and all that. That is when they have, which is that one. This is the standard for me. So it now depends on the composition of the capital. You know whether it is capital 1 or capital 2. So capital 1 plus 2, that is capital over assets. Then you express it in terms of capital.
In our own case, it's capital.
At least when you are doing the calculation in the financial management, financial analysis, you understand. That's what I just explained. Risk weighted assets, and I've explained what risk weighting means. That you assign a percentage of risk to your asset, depending on their liquidity position. Number one, how long will it take you to convert it to cash, and the risk you are exposed to. Like people that have fixed deposit in Benefit Bank, they wake up in the morning. So all those microfinance that have fixed deposit, yes, placements, they are all filling up. Some banks invested hundreds of millions. Yes, I know some banks that only that over 20 million. It has an insurance policy now, but there's a percentage now.
100%. 100 billion.
So, the maximum for I think 500 for individual, and I can't remember that one. You know, when that thing happened, some banks we are writing letter. We are not, you are a depositor into the, even as a bank. So the rule applies to you. This is a depositor's fund. They were writing up on that. Me, right from day one, I knew that it would not fly. Because they won't adjust the rule because of you. They won't adjust it because of you. It is the same CIBN now that know what happened, that knew how everything happened, are the ones that told them to write off. In fact, when they come to examination, they write it off themselves and let it from your capital. Tell you adjusted capital. 100%. 100%. You have to provide for it. In fact, some of them were. So what they did is when they come to examination, you are still carrying it as your investment. What they will do is after the examination, they will just, even if it shows your capital to negative, it's not their business. They'll just make 100% something. Because you're not going to get more than what the law, the NDIC provisions stipulated. Let me get the exact this thing. So, okay. Continue. I'm listening. Ask your question. I'm listening.
Okay, so now when you said you go to a bank and you see NDIC sure that as a customer. Now I want to talk as a layman, that somebody that does not know what's involved.
You are a layman.
At least I understand this stuff. So as a customer, I come to this bank, see NDIC insured. I know that okay, even if I put 10 naira, everything that happens, I'll get my 10 naira back. Then one day, I come, gate is closed. I ask for the manager, they say, they tired everybody that the bank are closed. I'm not looking for NDS in Apple. I say, okay, your money that is here, for those of you that have 20,000 to 1 million, what you get is 1,000 naira.
No, if you have below that minimum that they pay, you get your money. But before they pay you, they will make sure that you are not owing the bank. If you are owing the bank, they will let off your debt from it. Assuming you have 500,000 and you are owing the bank 300, what they will pay you is 200. So if your deposit is below that minimum of, I think it's 500,000. Yes. If you have below that, you will get all your money 100%. But if you have above that, you will be paid the minimum, because the insurance that the bank pays is also paid on that minimum in the position.
Let me come back to my question. So I see bank A as a stable bank where I can invest my money and invest them by picture, because I'm seeing FDIC of 5 million.
Yes.
And I come tomorrow, you tell me because I'm an individual, I cannot have my 5 million. So why don't you see FDIC when I have a cat in my house? And box where I can pick my details. So the box in my house is more NDIC.
You said, I think I was. You said, what did you say? I think I was. No, what did you say? I didn't get what you said. You said,
looking at the typical businessman that I am.
okay.
You are telling me that if I put money in this bank, it's better than when this is to come to my house. And I'm not knowing that the bank is the risk. Because they are saying NDIT short. Any money I keep here is safe. Now the person that came to marketing in my rice business, that put this money as a TV.
That's what you comment the NDIC sticker.
You understand? All this money you're putting here, take it, bring it to the bank. Anytime you want to do transaction, you do. And I've been doing it over time. I now develop trust. And I put all my money, 50 million.
Even if you have, I've gotten it. Even if you have 100 million, the maximum that will be paid is 5 million.
So I'm coming. Man, wait, I'm coming somewhere. So they say NDIC, my money is here. My money is 100%. I will get my money. Then tomorrow they say
where did you see that?
They say anybody you see NDIC.
Understanding as the neighbor.
Wait. Okay, let me ask you. At the point you are marketing the customer, are you dreaming that your bank will fail?
This is what I am telling you as somebody that has shop in and give me my money. Then he now came to me and said, any bank goes and NDIC, your money is
100%.
Now I'm going to Heritage Bank. I say my money is your NDIC. NDIC, they say CIBN. I go to CIBN, tell me.
You don't even have any business with these people you are calling. It is the bank, because when that bank is liquidated, the NDIC come and see those deposits and also loans. Like I said, if you have loans, let it off from the loan and pay you. If you have below that minimum that they are paying,
The CIBN themselves, or the NDIC,
it's NDIC that will show people.
before now knows that this bank has started trading. They are not doing well. They didn't tell the customer. They didn't tell anybody.
Wait. They are not supposed to see. Let me tell you. Before a bank fails, wait, I'm telling you, I'm coming. Before they liquidate bank, they have given that bank enough time, enough notice to inject more funds. Like I said, if you have an investment that you totally, maybe because of one reason or the other, investment I mean includes these deposits now. Assuming a bank went to a commercial bank and deposited, do a placement. It is an investment to the bank. You understand? And that investment, that's why I talked about this waiting. As soon as you have given somebody else that money, the probability or the assurance of you getting is no longer 100%. It can't be 100%. Anything can happen. Are you getting what I'm saying? But why they say when you see NDIC, you should relax, is because this bank is insured. Their deposits are insured, and the banks pay premium to NDIC. But into a maximum limit. It's just like when you want to do insurance. You don't do insurance open-ended. You do insurance to a limit. Maybe I'm insuring my car. You add a particular amount. The more you increase the cost of the car, the more your premium increases. So the bank also pays deposit based on the maximum amount that the NDIC can pay when the bank is liquidated. Are you getting it? Before they liquidate any bank, they must have given them enough time. Like I said, I know a bank that invested more than 100 million in Heritage Bank. When this thing happens, you can see that the only thing they can pay is 5 million naira. That is the only thing NDIC can pay them. Minus 5 million naira from 100 million naira. Is it not like 5 million? Assuming the capital of that bank is 100 million, they will go to that 100 million and remove 95 million. What it means is that you now have 5 million naira as your capital. This thing that is happening, your customers are not aware.
Okay, sir. Let's say that gone. So many other banks are about to go. If they are
no. See, it depends. So let me tell you, banks in Anna, but they have money.
Now, when this bank gets and then they allow the shareholder or maybe the people responsible for the management of the brand. And then the customer, they lose money.
Do you? No, they will pay them. The NDIC will pay them, but they will pay them to the maximum.
That's not. Sometimes
it's not politics. There's nothing like that.
This is what I'm saying. Okay, what are so with this information, as a bank account I have, we open like 10 accounts. This is my own opinion. Individual 500, not pass 500. Then I'll now go and buy cabinet in my house.
And that cabinet that you are putting it is safe. Abi? No, it is 100% safe. It is safe. Okay, it is safe. It is safe. So if a team goes into your money and carry everything, are you going to get compensated? Are you going to get compensated?
If the tips CIBN,
we do not carry this. Of course, now at every point in time, whether they merge or not, the only thing when they merge, it means that they have pulled the two deposits together, and you pay according to your deposit liability. So if the deposit of bank A is 100, then it's 1 billion. The other one is 1 billion. It is now 2 billion. So the premium you are going to pay is on the total at every point, and it's a yearly this. That means you pay according to your balance as at the end of the financial period, which is mostly 31st December. So whatever deposits you are doing,
how about the 95%?
that's what was the 95% and then
I'm telling you that maximum insured amount is the insurance and the premium that the bank pay is subject to that maximum amount. I don't know if you're getting what I'm saying. That portion, that's 95 million portion was not insured.
It's the same as the same thing as your boat, your this thing. Your boat in your branch. If you put $1 million in your boat, another is lost.
You see,
It's not like it's simple insurance.
maybe they need to review. But it is a policy thing.
Are you getting that? Remember that whatever we are saying, the probability, like we said, when you are doing your risk assessments, you look at the probability and the impact. One, has bank been failing in the if not for heritage that I don't think there's any, apart from people that made the banks that made, I don't think maybe in the last 5 years, I don't think there's any commercial bank that made. Are you getting what I'm saying now? So this one is one of.
We don't know.
Okay, you are looking for customers.
We are suffering for.
It's reviewed.
And if we not get deposits, better one that will be stable. Like I say, we have a leading in our cost.
Okay.
The customer really knows. Inside that disbursement, a little we pay salary, we do everything. And once they pay salary, head office you see what the branch you see people will do it. NDIC going on there.
I'm coming. Nothing will
The
happen.
consequences is heavy.
Not the consequences of bank failure is always heavy. So, of course. Of course. No, Tracy video, there's no this. This is government. But do you know there's a minimum you can do for presidential? You know there's a minimum. Unless for banks, what they do, whatever you collect, they will put you in the pool and do the there's a minimum. And I think the minimum is 10 million.
Individual cannot do it.
No individual can do it, but it is that's what I'm saying now, the minimum of 10. So, but what some banks do, because some people still do, what they do is that they pull, when 2, 3, 4, they pull it in and make it up to that minimum amount and then they invest. But what I'm trying to say is that the deposit, at least the assurance that when you put your money in a bank that is insured by NDIC, your money is safe, because if the bank is indebted, you're going to get it. Subject to, I didn't say 5% too, subject to the amount that you have and the minimum amount that NDIC is paying. So let's see. Are you there? Are you there? How do you not appreciate this? Are you there?
It's okay, leave it.
Wait, so you push it not talk too much, they are neglect also. So you don't apply that wrong. Okay, so let's, all this while we're talking about risk management. At least you've been able to know what risk management is all about. We've looked at the steps, the process. We've also looked at the various types of risk. We have the credit, we have the operational risk, the reputational risk, system risk, legal risk, and others. Of course, we have seen their parts, so that when we are faced with any risk now, I think by now we should be able to identify the type of risk that we are exposed to. When you see this thing happen, you say, this one is operational risk, or something happens, this one is credit risk. I know by now we have understood that it has gotten into our brain, and we know how, and we will better manage customers. Sometimes when you are appraising a customer, by mere interview, by mere speaking to the customer, you should be able to identify one or two things about the customer. Then you know how you can manage such customers. So we are done with the risk management aspects of the training. Then we want to enter internal control training. And internal control, this person defined it as it consists of all measures taken to provide management with assurance. The assurance that everything is functioning as it should be. That we have put the control measures. That all my businesses, all my processes, everything that I'm doing, they are quality assurance. They are good. Then Spicer and this person also defined the internal control system as system of control, a whole system of control, financial or otherwise, established by the management in the conduct of the business, including internal check, internal audit, and other forms of control. Then generally it is referred to as policies, procedures adopted by the management of an entity to help ensure, as far as it is practicable. It's not about, imagining it in your head. It has to be practical. The orderly and efficient conduct of the business. So when you hear that this is a policy issue, this is policy this one, this is our policy on this, this is our policy on this, all those things are referred to as internal control system. Those checks and balances are put in place to make sure that things are working the way they should, and that things are going on well. So that is what the internal control system is talking about. Those measures, policies, procedures put in place to make sure that things are working the way they should. Did you get that? Can we proceed? Then this is their objectives. The objective of the internal control system is one, adherence to management policies. Of course, like I said, the management policies includes this is how we are going to do this. This is how we want to do this. This is how we are going to discuss loan. This is how we are going to process our loan. These are the things that you are going to check to know that the customer is qualified to give you the loan. These are the control, the procedures or the policies that has been put in place to make sure that things are done well. Then it safeguards assets, prevention and detection of fraud and errors, accuracy and completeness of accounting records, timely declaration of reliable financial information, the set of statutory responsibilities, and protection of staff members against misinformation. These are the objectives of management. These are the objectives of the management, which are always, of course, the overall objective of the new business entity to make profit. So for you to achieve that, there are things that you do to achieve that. And the things that you are supposed to do, there are ways and manner that this should be done to achieve your. You don't just wake up and give loan, even though the motive or the purpose of that loan you are giving is to make profit. You do it anyhow, you don't do it anyhow. You understand? There are systems, there are controls, there are procedures, there are policies that are in place to make sure that you not only give that loan, but you give the loan to the right person through the right procedure. So let's move on. Then the objective of internal control. The other one is objective of the management. This one is the objective of the internal control itself. What's happening? Okay, then I hear you. And then somebody can respond. Ooh. No problem. So, objective of internal control, the transaction is executed in accordance with management general or specific authorization. Of course, you have authorization levels. So we say from 100, like the loan disbursement process now, or procedure, or policy. Area manager, branch manager, do you have limits? You don't have limits. But area manager have limits, Abby. This is area manager. Any amount above so amount goes to his internal control. You understand? To know that yes, anything above 300,000, bring it to us. Let us look at it and approve it by ourselves. But anything below that, you can see that the control there is that the area managers approve up to 200. So they cannot, unless the person has any other intention. Ordinarily, the policy does not allow the area manager to approve above 200,000 naira. So you can see it is an internal control system. Then the transactions are carried efficiently and effectively. Who can tell us the difference between it? The difference between efficiency or effectiveness. If you say you are doing something efficiently, what does it mean?
Efficient.
The timing, including resources. How much resources that you have used to execute that maybe let's say project or whatever. You look at the resources, you look at the timing. You understand? Then why effective is accuracy. So you have to consider it. You have to look at the cost. You also look at the cost I mean now, including time. You also look at the accuracy. Then all transactions are currently recorded as part. Okay, as to permit preparation of financial information within the framework of recognized accounting policy and practices, like the person that gave less than that said. You don't just wake up and do transaction. You have to do it in line with that this thing. First of all, you have to understand whether it is an asset or liability, whether it is expense or income before you know where you should. Assets are segregated from unauthorized assets, use or disposition. That's why you see when you enter some banks, you see the tag, the assets. All these things are in the internal control measures, so that you can't move. You can't move once they see the tag on it. Of course, they know that it's the bank property. You can't move it, and you can't sell. Some people use a permanent. Do is a permanent mark, while some people also use maybe a temporary one. But what I'm saying is, even when you take it to the market, once they see the tag, they know that this is not personal. The record assets are compared with the existing assets at reasonable intervals in appropriate asset with regard to any representative internal. Then elements of internal control. We have the control in environment control. We have accounting system. We have control procedures. Then environmental control is the overall attitude, awareness, and actions of the board of directors and managers regarding the internal control system and its importance. So the environment control, that is the controlling environment. The people at the helm of affairs are aware and actions of both the board and the management about the importance of the internal control. So the environment control is the awareness of just the top management, either the top management, the board, whoever, the awareness and the importance of internal control. Then we have the accounting system, of course, means some procedures and records with which identification of business transactions, classification, summarization, statement preparation, and analysis for timely preparation of correct information are performed. we keep saying. You don't just wake up and you start raising interest. There must be procedures. There must be way of doing it. If you want to raise expenses, there is it passes through 2 or 3 tables. The first person initiates, another person check, maybe the unit head, at least they are aware. What it means is that you can't just wake up in the morning, write the office, you go and collect money. So these things you can see they are controls. Even at the even you won't even conceive it in your mind because it won't fly. When you remember the processes that you're supposed to go through to get that money out, then you better not even, talk about it. Then the control procedure, the additional policies and procedures adopted by the management for ensuring achievement of the specific goal of the business. These control procedures are proper delegation of power. Nobody starts and ends transaction. Mr. A, this is your homework. Mr. D, this is your homework. And this is where you stop. When you start from this point, you stop at this point. Mr. C, you start from this point and end. So people have their different duties that they are doing. Then it's the division of responsibility. Preparation and use of documents. Adoption of adequate security measures to protect the properties, independent control over the execution of it. So these are the control procedures. These are the things that you make sure that things are going well. You can say you want to execute a particular project. You say, okay, A, B, C. You may not say one person will go and do it. Because if one person does that, you know the implication. Probability is that the person may compromise. But when you delegate, maybe you set up a committee who are supposed to execute that project, and you give them terms of how do I put it again? How they are supposed to do that. Maybe you tell them, okay, before you can agree on the amount, you get quotation from A, B, C. You give them terms of reference. A, B, C. When you do is, okay, bring out of them, let us look at it. What next? Who is going to do it better than the rest of it? These are the, you make sure that you don't give one person so much power, to warrant the person to start, thinking of what to use that power that you have invested in them or on them. So let's see. Yeah. Then the limitations of internal control. Even though we're talking about all these controls, okay, it's also a form of risk management. It safeguards the shareholders' fund. It increases the bank's reputation. It makes sure that things are going on the way they are. It improves even the staff and the customers' confidence and everything. Of course, in everything, there are limitations. First one is cost versus benefits. To train people or to attract the right people is always expensive. So for any control measure you want to put in place, you look at this cost versus the deposit. What is the cost of doing this? What am I going to get out of it? If the cost far more outweighs the benefits, what do you do? Even though it's good for you to do it, assuming the cost is bigger than the deposit, what do you do? Than the benefit, what do you do? And you got the cost and you're also exposed to risk. There are abnormalities. Control are typically directed towards normal everyday transactions. The abnormal and unusual transaction is generally not covered. Primarily because of cost benefit. There are things that are normal and there are things that are also abnormal. So the abnormalities are also because your focus is on the normal ones that you feel, but they are the ones that may also happen, which are abnormal. So most times you lose sight of them because you are concentrating so much on the one that. Then, of course, human error. Human error can also be the so this also always be present in some unintentional errors. And you know that there are some mistakes that will also cost you so much. There are mistakes that you do, and you know, it will cost you so much. Then start turnover. When the staff is already new to the system, the person needs to be the environment of the place. The person has already created in the area for some time, normally more efficient, of course. Whoever that is taking over, will also take that person some time, you know, to learn and also master what the workload. If the workload is so much, they will come and there are some people who intentionally are waiting for you to be exhausted. They will now go and put something at the back and give you because you are already exhausted or the workload is so much. You are not trying to, you know, meet up with whatever you are doing and you are signing and signing and signing. When they bring that transaction to you, did I sign this thing? How did I sign this thing? Is it that I didn't read or what? So workload can also be a limitation to internal control. When you have an overload now, of course, you may not tend to check all the things you're supposed to check, all the processes that transaction is supposed to go through. You may not have time to check on them. Then collusion. You know, I told you a story about a control person that colluded with, how would I say it? A customer. You know, the risk management, the mitigants or the control that we put in place is that before a customer takes money, the customer will write, you call. So the person that was supposed to call is now the person that did the fraud. Have you seen that you have not successfully managed the risk around that transaction? Our focus was on the loan officer. Then the control, you practically eliminated the control person, the risk on the person that is the authorizer. So because the guy knows that as soon as he authorizes the money flight, he took that advantage. And of course, he didn't do it alone. Because he's not the person that will initiate the transaction. What he did was he used a customer. No, not a customer, a staff. So some of those accounts that customers don't normally withdraw money from, they now just pick them. The person now claims that it's my customer, and he will now authorize. So when there is collusion, no matter the type of internal control system that you put in place, those people in that line, that process line, if they compromise, you now have staff irresponsibility, of course. When the staff knows what they're supposed to do and decide not to do it. The person that is checking, if you decide not to check, is also a limitation. So I think this is a nice thing. Can you move forward? So I think we are done. So for some of you who is going to write exam, this is good luck, and I hope that you get all the information, and when you see them in this thing, like when I was providing the slide, I had to, you know, go beyond the manual as the battery itself in order to bring this thing home. So it is also okay that you read the manual. And the only thing is that the manual is said there are some places that they keep repeating the same thing. You try as much as you can to grab the central information or the main points and go your way. So, like I said, the purpose of the training is not to go and pass exam. It is also to, you know, develop yourself and be in a better position so that you even understand why management is taking some decisions. Like last week, the person that facilitated last week talked about prudential guidelines. That shows you that as a bank, you don't just wake up and say, this is what I want to do. If you do that, you are exposing yourself to compliance risk. And when you are sanctioned, you know what it means. So it means that You don't just wake up and do what you want to do. You do things according to the guideline. You have CBN guideline for microfinance bank. In fact, microfinance bank, I think by next month they'll be celebrating their 20 years. This thing. So that means it has even come a long way, and by now their expectation is that there must have, of course, there should be improvement in everything that they used to do, and they also expect that the people that are managing microfinance banks now, or people that are working in microfinance banks, at least have a reasonable level of exposure, so that you'll be able to understand how things are done. You don't just there are limitations to everything. Like you don't deal with international transactions. Not that you don't have money to do it, but the policy limits you from doing that. You have what we call permissible activities. You understand? The permissible and the other one. The ones that you're supposed to do and the ones that you're not supposed to do. So when you are called a microfinance bank, does not mean that you are limited by money. Maybe the catchment and the target clients that you're supposed to deal with. It's wide that not that micro, people sometimes you tend to see ourselves less. It's not that we are less, it's just that we give a special, our services is kind of specialized to a particular set of people. Yes, not that. And when you even say economic acting for, somebody will give 20 million naira. That's economic acting for. You need to have 20 million, but you say that person.
People that are rich are from 500 million banks.
Are you serious? Is that it? Who did the survey?
Yes, that's from 500 million. That's why you're now the economic report. So if you are giving 70 million naira loan, there is 4 man.
You're a 4 man. Wow.
So that's like I'm
So that is what I'm trying to say now. Don't see yourself less. Don't see yourself less. You know they keep on telling you that what you know at your level, some branch managers in commercial banks do not know, because they don't even understand the dynamics of managing bank. They don't even know how these things happen. At what point, when you say this is this, do they really understand what it means and translate it to what they are doing? So
I told him that I want to be clean.
how can you say that is that person a banker? Not to know what his mind is. I think she can. Okay, no problem. So you do through bank. You can, yes, as a bank. It is between you as a bank. You invested. The bank is your custodian. You understand? It's your custodian that you invested in, but you do it through bank. You don't know. I said there is a minimum, but like I said, some banks who funds. All those people that don't have up to that amount, you just gather you people who want this thing. But they'll give you separate investment papers. To the tune of your investment. No. CB is CBN. It's CBN commercial system. It's CBN that issues. They use it to raise funds from the public. So it is CBN that sells treasury bills. It is not bank. Yes, they raise funds from the public, but they do it. You don't go direct. They do it through banks. So the bank you are passing through is your custodian. So the bank bids for the general population. No, there's no risk. I just say this. There's no risk. There's no. So yeah, I hope we are good.